You're about to watch your neighbor lose their house. Not because they're irresponsible, not because they made bad choices, but because they believe the lie everyone's been selling for the last 4 years. Right now, as I'm talking to you, there's a 12 trillion time bomb sitting in the American housing market, and the fuse, it's already burning. Here's the number that should terrify you: 67%. That's how much of the average American's net worth is locked inside their home. One asset, all your eggs, one basket, and that basket is about to get dropped off a cliff. I'm going to show you something in the next 20 minutes that you won't see on the news. Not because it's secret, because it's too obvious. The pattern has played out 3 times in the last century. And right now, frame by frame, it's happening again. The Treasury just absorbed $23 trillion in mortgage-backed securities in 6 months. JP Morgan Chase sold off 40% of their residential mortgage holdings in Q3 of 24. And in November, Deutsche Bank quietly announced $1.22 billion in losses tied to real estate derivatives. These aren't random events, they're choreographed exits. The smart money is already gone, and they left you holding the bag. By the time I'm done, you'll see exactly how this machine works. You'll recognize which stage we're in, and you'll understand why 40 million people, maybe you, are about to discover that your biggest asset is actually your biggest liability. Let's start with how the trap works. Every financial collapse follows the same blueprint. I call it the leverage ladder. 4 stages, same sequence every single time. Stage 1 is the foundation. This is where everyone feels wealthy. Asset prices climb month after month. Credit flows like water from a broken pipe. Your neighbor refinances to buy a boat. Your cousin with a 590 credit score gets approved for a $400,000 mortgage. Nobody questions it because everyone's winning. During 2021 and 2022, U.S. mortgage debt jumped by $21 trillion. That's not growth, that's leverage. Borrowed optimism. And here's the thing about borrowed optimism. Eventually, someone wants their money back. Stage 2 is the trap. This is where it gets interesting. The general public is still celebrating. Prices are still rising. But if you know where to look, you'll see the insiders heading for the exits. Check SEC filings from the fourth quarter of 2024. CEOs from the top 12 mortgage lenders sold $487 million worth of their own company stock. Not diversifying, not retiring, selling. They're reading the same data you can access. They just know what it means. Interest rates are high, but prices haven't corrected. That gap, that's the trap. Think of it like scissors. The blades are spreading apart and your neck is right in the middle. Stage 3 is the trigger. Something breaks. It's never the thing everyone's watching. In 2008, it was subprime mortgages, loans so small that Fed Chairman Ben Bernanke said they were contained. In 1929, it was margin debt that nobody thought could crash the entire economy. The trigger is always something the experts dismiss. Too small to matter, too isolated to spread until overnight. It's the only thing that matters. In stage 4, that's the cascade. This is where time compresses. What took 10 years to build unwinds in 10 weeks. Forced selling margin calls. Liquidity just vanishes like water down a drain. Your house isn't worth what Zillow says anymore. It's worth what someone will pay when everyone's selling at once. And what someone will pay is a lot less than you think. Now here's where it gets wild. This isn't theory. This exact sequence has played out 3 times in modern history. And each time millions of people stood there saying, "It can't happen to me. Let me show you." Everyone knows about the stock market crash of 1929, Black Tuesday. Bankers jumping out of windows, bread lines stretching for blocks. But here's what they don't teach you in school. The crash didn't start on Wall Street. It started in Florida. Real estate 3 years earlier in 1926, picture this. Miami in the mid-1920s, land speculation has gone completely insane. People are buying swampland plots sight unseen. Developers are selling prime beachfront property through newspaper ads to buyers in New York and Chicago who have never even visited Florida. The scheme is beautiful in its simplicity. You put 10% down on a piece of land, flip it to the next speculator before your next payment is due. Everyone's making money. Everyone's a genius. Then in September 1926, a Category 4 hurricane slams into Miami. Suddenly, people actually go look at the land they bought and they discover something inconvenient. Half of it is literally underwater. Not because of the hurricane. It was always underwater. It's swampland. It always has been. The bottom falls out. Overnight, $1 billion in real estate value evaporates in 1926. That's about $18 billion in today's money gone. But here's the part that matters. Nobody connected the dots. Everyone said that's just Florida. Regional problem. The national economy is fine. Except it wasn't fine. Those Florida land deals had been financed by rural banks across the country. When the land became worthless, those banks started failing. By 1929, over 600 banks had already collapsed before the stock market crashed, before anyone panicked. The stock market crash on Black Tuesday wasn't the cause of the depression. It was the symptom. The real estate debt had already spread through the financial system like poison in the bloodstream. The stock crash was just when everyone finally noticed the patient was dying. And here's the detail that should make your skin crawl. In 1928, a full year before the crash, wealthy insiders started moving their money. J.P. Morgan personally moved $60 million in gold to European vaults in the spring of 1928. The Rockefellers quietly shifted into treasury bonds. They saw it coming. But the average homeowner, they didn't lose their house in 1929. They lost it in 1933, 4 years later, because banks started calling in mortgages early. Not because borrowers defaulted, but because banks needed liquidity to survive. Your house wasn't your asset. It was the bank's emergency exit door. Millions of people who made every payment on time still lost everything because the system failed. They were standing too close when it collapsed. Now jump forward 60 years, it's 1986, Reagan is president, the economy is booming, Wall Street is printing money, and 747 banks are about to disappear. The savings and loan crisis is the collapse nobody remembers because it happened slowly, like carbon monoxide poisoning. You don't notice anything wrong until you're already dead. Here's what happened. In the early 1980s, Congress deregulated savings and loan institutions. These were the community banks that held your mortgage and your savings account. Boring, stable institutions, except suddenly they weren't boring anymore. The new rules let them make risky commercial real estate loans. They went absolutely insane with it. In Texas alone, SNLs financed entire empty office parks, buildings with zero tenants, pure speculation. By 1985, commercial real estate vacancy rates in the Southwest hit 30%. 3 out of every 10 commercial buildings were completely empty, and here's the smoking gun that should enrage you. In 1984, federal regulators knew. The Federal Home Loan Bank Board had internal memos showing that nearly 500 SNLs were technically insolvent, bankrupt, dead institutions still walking around, but they buried the reports. They didn't want to spook the market. They thought they could manage it quietly. Let the problem institutions slowly fail without triggering panic. That plan worked great until it didn't. When the dam finally broke in 1989, it cost taxpayers $132 billion to bail out the system. But here's what they don't mention in the history books. Over 1,000 SNLs simply vanished. If your mortgage was owned by one of those banks, congratulations. Your loan got sold to a vulture fund, and that vulture fund immediately changed your terms or started foreclosure proceedings. Hundreds of thousands of people who had been making their payments to a local bank they trusted suddenly found themselves dealing with a collections agency in another state that didn't care about their situation. And here's the truly insane part. Many of these failed SNLs had invested depositor savings into the same risky real estate projects they were financing. Your savings account was funding the bubble that would eventually destroy your savings account. The snake was eating its own tail. The crisis only ended because home prices kept rising in coastal markets. California and New York bailed out Texas and Arizona. The disease didn't get cured. It just moved to a different part of the body. Now let's talk about the dress rehearsal, the one you definitely remember. You know this story. Lehman Brothers, Bear Stearns, too big to fail. The Great Recession. Foreclosure signs on every block. But let me show you the frame everyone missed. The 2008 crash didn't start with subprime mortgages. It started in 2004 when the SEC made a boring regulatory change called the net capital rule. This change let investment banks leverage themselves 30-1 instead of 12-1. Read that again. Banks could suddenly gamble $30 for every $1 they actually had. So they did. They packaged subprime mortgages into something called CDOS, collateralized debt obligations. They got ratings agencies to slap labels on them. And they sold them to pension funds and retirement accounts as safe investments. Except they weren't safe. The banks knew they were garbage. And here's how we know they knew. In 2006, Goldman Sachs created a CEDO specifically designed to fail. They called it Abacus 27 AC1. They sold it to clients while simultaneously betting against it. When it collapsed, Goldman made billions. Their clients lost everything. This isn't conspiracy theory. It came out in Senate hearings. It's documented fact. When the crash hit in September 2008, 38 million Americans lost their homes to foreclosure within 2 years. Not because they were irresponsible, not because they lied on applications, but because the entire system was built on fraud from the beginning. And here's the part that connects to right now. We didn't fix the problem, we made it bigger. The Federal Reserve dropped interest rates to zero and printed $4, some $5 trillion. That money flooded into the economy. And where did it go? Real estate. Again, we solved a debt crisis by creating more debt. The bubble didn't pop. It just inflated larger. And now, 16 years later, we're standing underneath a balloon the size of the moon, and someone just pulled out a needle. Let me show you exactly where we are on the leverage ladder. And I'm going to give you specific dates and numbers because this isn't speculation. This is documented reality. We finished stage 1. The foundation between 2020 and 2023. During COVID, mortgage rates dropped to 27% free money. Housing prices jumped 40% nationally in 3 years. If you bought a $300,000 house in January 2020, it's supposedly worth $420,000 now. But here's the reality check. According to the Atlanta Fed's Homeownership Affordability Monitor, as of November 2024, the median household needs to spend 41% of their gross income to afford the median-priced home. The historical average is 25%. We're 60% above sustainable levels. That's not a market. That's a Ponzi scheme, and we're running out of new buyers to keep it going. Now we're deep into stage 2, the trap, and the signs are everywhere if you know where to look. In March 2024, something critical happened. The yield curve inverted for the 18th consecutive month. That's the longest inversion in recorded history. And here's what's terrifying about that. Every single time the yield curve has inverted for more than 12 months, a recession has followed within 18 months. Every single time. But that's not even the important part. In August 2024, Japan raised interest rates for the first time in 17 years. You might be thinking, who cares about Japan? You should care because Japanese banks hold over $1.2 trillion in U.S. mortgage-backed securities. And when Japan raised rates, the carry trade collapsed. Within 72 hours, U.S. mortgage bond prices dropped 8%, the fastest decline since 2008. The Federal Reserve had to step in and buy $80 billion in mortgage-backed securities just to stop the free fall. That wasn't normal market operations. That was emergency intervention, and it barely made the news. Now, layer this on top. As of December 2024, $1.05 trillion in commercial real estate loans are coming due between now and the end of 2026. These are office buildings sitting empty because everyone works from home now. The default rate on these loans is already 12%, triple the historical average. When these buildings get liquidated at 40 or 50 cents on the dollar, those losses don't just disappear. They flow directly into the balance sheets of the banks that also hold your residential mortgage. We're not watching disconnected events. We're watching dominoes getting into position. Here's what mainstream financial media is missing. They're watching the Federal Reserve. They're watching unemployment numbers. They're watching inflation data. They're watching the wrong thing. The trigger is hidden in the derivatives market, and almost nobody's paying attention right now. U.S. banks have $210 trillion in outstanding derivatives contracts. Let me put that in perspective. That's 8 times the entire U.S. GDP. Most of these contracts are interest rate swaps and credit default swaps tied to real estate debt. These derivatives work like insurance policies. Bank A promises to pay Bank B if certain conditions are met. Bank B promises to pay Bank C. Bank C promises to pay Bank A. It's a giant circular chain of promises, and it works perfectly as long as everyone can pay. But the second one link breaks, the entire chain explodes. Think about Lehman Brothers. In 2008, Lehman didn't collapse because their mortgages went bad. They collapsed because nobody would trade with them anymore. counterparty risk. When other banks stopped trusting Lehman's ability to meet their obligations, liquidity vanished overnight. On November 14, 2024, Deutsche Bank announced $1.2 billion in losses on real estate-linked derivatives. Not a default, just losses. That's the first crack in the dam. Here's what happens next. When one major bank fails to meet a margin call on these derivative contracts, every other bank freezes. They stop lending, they stop trading, they hoard cash. Credit market seize up like an engine without oil. And when credit freezes, the housing market dies because 90% of home purchases require a mortgage. No credit means no buyers. No buyers means prices collapse. The Federal Reserve knows this. That's exactly why they absorb $2–3 trillion in mortgage-backed securities this year. They're trying to become the buyer of last resort before the cascade starts. But they can't buy everything. The market is too big. The leverage is too extreme. And everyone in the financial system knows it. Let me give you the roadmap. This is how the dominoes fall. Domino 1 drops in Q1 22-25. Commercial real estate defaults accelerate. Regional banks, not the big names, but the mid-tier lenders in Phoenix and Nashville and Boise start failing. When one goes under, depositors panic and bank runs don't look like the old days anymore. There are no lines out the door. It's just people clicking transfer on their phone at 2 a.m. Domino 2 drops in Q2 2025, credit card default spike. As of October 2024, credit card debt hit $13 trillion with delinquency rates at 3.1%, the highest level since 2011. When people can't pay their credit cards, they stop paying their mortgage next. It's that simple. Domino 3 drops in Q3 2025. Forced selling begins. All those homeowners who bought at the peak in 2021 and 2022 with 3% down have zero equity buffer. When prices drop just 10%, they're underwater. Walking away becomes the rational choice. 4 foreclosures flood the market. Domino 4 drops in Q4 2025 or Q1 2026. The cascade prices fall 20 to 30% nationally faster in the overheated markets like Austin and Phoenix and Boise. Banks holding these mortgages have to mark them to market. Their capital requirements get violated. Lending completely freezes. And if you need to sell, there are no buyers. If you need to refinance, there are no loans. If you need to tap your equity, there's no equity left. That's when 40 million homeowners wake up and realize they're trapped. They own an asset they can't sell, can't refinance, and can't afford to keep. I know what you're thinking right now. You're thinking, okay, but this time is different. Because let me stop you. That sentence, "this time is different," has been uttered before every collapse in recorded history. It's the 4 most dangerous words in the English language. You're thinking the banks are more regulated now after 2008. Dodd-Frank stress tests, capital requirements. All true, but Silicon Valley Bank passed its stress test 1 month before collapsing in 48 hours in March 2023. Then Signature Bank went down, then First Republic, 3 major banks gone in 8 weeks. The regulations didn't fail. They just don't account for speed. Money moves at the speed of the internet now. Regulations built for the 1930s are like bringing a sundial to a rocket launch. And those regulations only apply to traditional banks anyway. Not hedge funds, not private equity, not the shadow banking system that now controls $52 trillion in assets. Twice the size of the traditional banking sector. The risk didn't disappear after 2008. It just moved where regulators can't see it. You're also thinking people have more equity this time, not like the subprime borrowers in 2008. True, the average homeowner does have more equity, but averages lie because 63% of all mortgages issued since 2020 went to first-time buyers. These people bought at the absolute peak with minimal down payments using FHA loans. When prices drop 15%, they're completely wiped out, and they represent 28 million households. Meanwhile, corporate investors now own 7% of single-family homes, up from 2% in 2019. These aren't homeowners. They're fiduciaries managing other people's money. When the market turns, they don't write it out. They liquidate fast. And that accelerates the cascade. And your final objection? The government will bail everyone out again. Will they? Let's do the math. In 2008, the bailout cost $700 billion in TARP plus $45 trillion in Federal Reserve asset purchases. Total about $2 trillion. The mortgage market today is $12 trillion. Commercial real estate is another $5 trillion. Credit cards, auto loans, student debt. Add it all up, and you're looking at a potential crisis twice the size of 2008. The Fed's balance sheet is already $7.4 trillion. The national debt is $36 trillion. The deficit is $2 trillion per year. The political will for another massive bailout, especially to help rich homeowners, doesn't exist. They can't print their way out this time without either crashing the dollar or triggering a political revolution. Probably both. So, no, this time isn't different. This time is worse. Here's the pattern in one sentence. Debt-fueled asset bubbles always collapse when the cost of servicing the debt exceeds the return on the asset. We're there. Now, what do? First, calculate your real mortgage to value ratio. Not what Zillow says, what you could actually sell for if you listed tomorrow and needed to close in 30 days. Be honest. Subtract another 10% because prices are falling, not rising. If you're above 80% loan to value, you're in danger. If you're above 90%, you're holding a time bomb. Second, build liquid reserves immediately. You need 12 months of expenses in cash. Not stocks, not crypto, not home equity, actual cash. High-yield savings accounts paying 4 to 5%, treasury bills boring and safe. The goal isn't to get rich, it's to survive. When credit markets freeze and you can't access anything. Third, stress test your income. If you lost your job tomorrow, how long could you make your mortgage payment? If it's less than 6 months, you have 3 options: increase income, decrease expenses, or sell before the market turns. I know that sounds extreme. It's supposed to. Fourth, if you're staying in your house long term, get a HELOC now while you still can, even if you don't need it. Having an open line of credit before banks shut them down gives you options when everyone else has none. And fifth, if you're liquid and stable, position yourself for the opportunity. The cascade creates generational buying chances, but only if you have cash when everyone else is forced to sell. I'm not saying crash your lifestyle to time the market. I'm saying don't be the last person to figure out the music has stopped. The pattern has repeated across centuries, countries, and currencies. The technology changes. The terminology evolves. But human nature, greed, denial, panic stays exactly the same. In 1929, people believed the market had reached a permanently high plateau. In 2006, people believed housing prices never go down. In 2024, people believe the Fed has our back. The Fed doesn't have your back. They have the system's back. And if saving the system means you lose your house, that's a trade they'll make every single time without hesitation. 40 million homeowners aren't going to lose everything because of bad luck or cosmic accident. They're going to lose everything because the math demands it. The leverage must unwind. The debt must be destroyed. And if you're standing on the wrong side of that equation when the music stops, no amount of hope or prayer will save you. The trigger is already pulled. The bullet is already in flight. The only question is whether you're standing in its path. I'll see you in part 2, where I reveal the 3 specific markets that crash first, the one bank signal that tells you the cascade has started, and the single asset class that actually gains value when housing collapses. Subscribe, hit notifications, because when this breaks, it's going to break fast, and the information you need won't be on the evening news until it's already too late. In every crisis, fortunes aren't destroyed, they're transferred.